Recent market sell-offs linked to geopolitical tensions were sharp but short-lived. And with US markets already back at record highs, investors who bought the dip have once again been rewarded. But analysts say not every market decline is a buying opportunity. So how do investors tell the difference between a temporary pullback and a warning sign that something more serious is happening underneath?
So my biggest mistake was actually panic selling.
For 36-year-old investor Justin Bui, that experience changed the way he approaches market sell-offs today. Buying the dip means buying an asset when its price is falling, with the hope that price will recover in the future. But analysts say investors first need to ask themselves why markets are falling. Because some sell-offs are driven by temporary panic. Others reflect deeper problems with a company, sector, or economy.
If we do see the price actually drop very sharply, such as 10% or 20% or even more in a single session with high volume, I think that would represent something more than just buying the dip. I think that would represent a company-specific news that may have impacted the fundamentals. In times of high volatility, so I would think that cash flow matters the most, because in these situations, companies need to have the cash buffer to actually ride out this kind of difficult periods. And also debt levels will actually matter as well, as credit markets tend to tighten during these periods, and highly levered companies may actually face cash flow issues.
That's why experienced investors say managing risk matters just as much as spotting opportunities.
I like to view things like a sovereign wealth fund or a pension fund.
Instead of chasing short-term gains, Justin invests with a 20 to 30-year horizon, and he keeps part of his portfolio in cash.
I feel that psychologically, having some cash on the sidelines actually helps you to deal with market downturns.
The medical doctor keeps about 20% of his portfolio in cash, ready to deploy during market pullbacks. But unlike investors who rush in all at once, he buys gradually.
Whenever there's a 5% drawdown, I would deploy about 1 to 2% of my cash. And when there's a further dip of about another 2 to 3 more percent, I would deploy another 1 to 2% of my cash. At certain times whereby there's a lot of volatility, which is when VIX typically spikes more than 25, I see this as a potential moment whereby the market has extreme fear. Okay, and I would even deploy a little bit more during that period of time.
I think the biggest mistake that investors make when buying the dip is they tend to go all in when the market drops. The first drop comes in at 1 to 3%, and then afterwards, subsequently, if the market does fall further, for example, 5% or 10%, they don't have any more cash reserves to actually capitalize to buy more. And that leaves them stuck in a higher cost price as well.
Justin says the biggest challenge in 2022 wasn't the market decline itself, but staying disciplined while waiting for markets to recover.
In 2022, the markets dipped and kept on dipping, and it dipped for more than 6 to 12 months, and I panic sold some of my positions because I thought I was, taking a stop loss on that, and I was ready to deploy it into other positions, but I should have held longer because eventually the markets went up. So I forgo about 20% of gains in the market. Yeah, and if you look at the compounding over time, that is actually potentially more that that I actually lost out on.
Today, markets have already rebounded from recent volatility to fresh highs. But investors say future corrections may still test their patience.
Markets might stay down longer than expected. So the horizon that I give myself is that markets might stay down for about 1 to 2 years. And so you have to be quite careful not to deploy all your cash during that dip, you also have to make sure that you have enough cash on the sidelines, because other aspects of your life might require you to have, cash injections.
Timing the bottom is notoriously difficult, and there's a statistic that shows that if you miss out the 10 best days of 10 best market days, your returns can get cut in half. And also, the 10 best days tend to occur after the worst days in the market. So it's very difficult to time the bottom, and investors should just consider dollar cost averaging as a better strategy.
Some investors use technical indicators like moving averages or the VIX fear index to track periods of extreme market fear.
A few signals that investors can look at to gauge whether a market has more or less bottom would be the volatility index, or the VIX. When that reading hits 30 or more, that kinds of signals the market is in a heightened fear mode.
But technical indicators alone can't guarantee markets have bottomed, which is why some investors prefer broad-based ETFs instead of concentrating on individual stocks.
I try to stay away from single stocks unless I have very high conviction about that stock, or if I am an insider in that particular sector. I try to keep things broad, so most of my public equities investments are in an exchange-traded fund that tracks stocks in the developed world. So this ensures that I'm investing in markets that in general would go up over the long run, bearing in mind that our time horizon is about 10 to 20 or even 30 years, not 1 to 2 years. In 1 to 2 years, it's hard to tell where the market direction might go.
It's safer to buy broad-based ETFs, as investors can eliminate idiosyncratic risk, which is company-specific risk that they are exposed to. And also, by buying broad-based ETFs, they actually can ride the market recovery regardless of which sector recovers after the sell-off.
Recent market rebounds may have rewarded dip buyers once again, but experienced investors say successful dip buying still depends on distinguishing temporary fear from deeper market risks. Because in volatile markets, surviving the downturn may matter just as much as profiting from the rebound.